From the morning reading, broad rally lifts the SPX and NDX. Oil rises again. All 9 sectors moved higher on Friday. XLE, XLK, and XLF were the strongest sectors, while XLI was the weakest sector. Oil rose $2.17 to close at 32.25. Breadth strengthened as advancers led decliners 8.35 to 1 on the New York Stock Exchange and 4.41 to 1 on the NASDAQ. The weekly candle shows that institutional buying was strong enough to create a long-tailed hammer bullish reversal pattern on the weekly chart. The falling VIX confirms the SPY bullish pattern. Over the past 2 years, prior market rallies were also led by a bullish weekly candle pattern. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:59 a.m. Central Time, and I'm recording this in preparation for the market day, January the 25th, 2016. Full disclaimers at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. Much quieter overnight action than what we've had oftentimes in recent trading sessions. All four of the U.S. broad market indices are down, but that's just down weekly, and indeed, even by the market open, this could be scratch or even slightly positive. It certainly has no significant action here. The S&P futures are down almost 3 points to about 0.14. Russell futures are down more, about 0.5%. NASDAQ, like the ES, just down marginally, as is the Dow. Crude oil, though, is a big mover, and surprising given the correlation we've had between crude oil and the broad market of late, that this has not affected the broad markets more. It's down some 86 cents to 2.67%. Euro is up about 0.25%, bonds are up about 0.3%, and gold is up about 0.8%. So we got pretty big movement on crude oil and gold, but the rest of these haven't really done much of late. China is up about 0.75%, Hong Kong over 1%, Japan just under 1%, Germany is at scratch, as is the United Kingdom. In terms of macroeconomic reports for today in the United States, it looks like scratch. I don't see anything there for the U.S. In terms of looking forward, we have some yellow flag reports, fairly benign in terms of market movement. Now, we do have consumer confidence tomorrow, and that is a red flag report. So that's what we've got coming up. In terms of volatility, we've had quite a bit of ebbing of volatility. We remember this short-term VIX was up over 30 just in recent sessions, and it has cratered all the way down to 22. So still elevated, but nowhere near the level of volatility that we had just a session or two ago. In terms of skew, also still elevated, but also not as high as it has been. And the same is true for the IV percentiles. S&P is at a 38th, Russell 42, the NASDAQ 43, and the Dow 44. So again, relatively low, though not as low as it's been and not as high as it's been. So we're kind of middle of the road. No standard deviation moves were put in on Friday across any of the four broad market U.S. indices. Let's take a quick look at the charts. And on the S&P, you see we saw this big capitulation kind of move and reversal hammer pattern. That was followed by a bullish harami on the SPX, and then confirmation the break out of this bottoming pattern. And as you heard in the morning reading on the weekly, we also had a bullish reversal pattern. So question now is, what next? The most likely target, if we are to continue this move, is this swing high right here, so about 1950. And then, of course, the other question is this just become another bear flag? And certainly our overnight activity thus far today doesn't give us much direction in terms of what to expect from today. We could have just another inside day to digest the recent moves of the last couple, really 2.5 trading sessions. So we'll see where that goes. But your first hypothesis is at least to go up to this 1950. The second hypothesis is to watch for this to roll over. If that happens, then we'll almost certainly retest these lows. In terms of the Dow, very similar pattern, nothing really to separate these. NASDAQ, it had a gap and go on Friday, so that was pretty significant bullish activity there. And then the Russell, very much the same. So we've had these kind of bullish reversal patterns. Now, it's the same case in all these. Is this just going to be setting up for a bear flag and then roll back down, or do we get something more pronounced? We had a pretty significant move, and this was really oversold, so that we would have a reversal pattern and a bounce is not unexpected. We certainly expected that. At the same time, though, what we don't know is, have we changed the trend? And the trend is bearish. And indeed, let's go ahead and go to the daily report. And you look at this, the intermediate term phase opinion, still phase one, bear flag reversal. This is somewhat described as a fat toe in the water. If you're going to do anything at all, it's out of the money puts and reduce stock positions at this point. What are we looking for in terms of what would make that phase two? Well, we've had the beginning of that process, but we certainly have not had the finish to take it to phase two. We've had the break of this diagonal resistance. It did that on Friday. So we've had the reversal pattern, we've had the break, but we have not yet cleared the 10 EMA that would give us permission to move to phase two. Our portfolio investor posture still, this is all decidedly bearish at this point. We've just had the early signs of a reversal, nothing yet to confirm. IBD status remains market in correction, and I say confirm in terms of an intermediate term basis. Remember, all this is kind of primarily focused on the intermediate to long-term basis for a portfolio investor posture. So let's be clear about that. Accumulation distribution in the S&P still an E, the NASDAQ also an E. GMI index remains a 0 out of 6 with a sell signal since 1210. The stock charts decision points you see is still decidedly, especially the short to intermediate term, universally neutral to bearish, and most of the long term is also bearish. In terms of that intermediate term market posture, we're still severely bearish with a bearish sentiment line. So we expect that the down moves will be prolonged and larger than the bullish moves. In terms of position sizing opinions, right now we have a 0% on the portfolio investor position sizing opinion and a less than 50% on the volatility-based system. In terms of that intermediate term market posture, you see all four of these still under 20, still all severely bearish. We don't have any clusters or anything like that. It's a situation where we've had in the short term some signs of a reversal with a confirmation, but that hasn't yet put in a higher high, and for most and certainly not a higher low as of yet. So it's just early signs of a reversal pattern. Hedge warning status remains level 3, which is crash warning. Until we start to see some of these warnings ebb, this will remain at level 3. We have seen some ebbing, but there's still a lot of red down here, so don't get complacent after just 2.5 days of a reversal. It may seem like a big move. Well, that's exactly what you get in bear markets, big rallies, but then failures. And we still have market in decline and the volatility. We still have VIX futures up over 18. We still have, in terms of a distribution day count, a market and correction signal. We still have a volatility ratio warning, which has had a first day close back inside, so that's setting up for a market reversal sign. So that's actually both a warning and a potential promise for something better. Skew remains elevated, about a 10% probability for a 2 standard deviation move in the next 30 days. The current week out expected move, I should say, on the SPX is a 69. So that's also still very, very elevated. You have new highs, new lows, even with that big bullish move on Friday. We had very few new highs being put in on the New York Stock Exchange. So, in fact, we even had, while these levels are relatively benign and not reaching the warning status of a 300, we even had more new lows than new highs on the New York Stock Exchange for Friday's action. In terms of the key intermarket risk aversion indicators, we have had one now go to risk on, and another one of these is curling up, so it could potentially go to risk on. So some improvement there. Also some improvement, but very, very minor on the fear and greed index. It's at a 14. The last reading was a 13. In terms of special opinions, we're still outside the acceptable window to initiate new positions for novice traders on all three systems. Got a couple different notes here for the aggressive traders. With respect to covered calls, the suggestion is to go with no in the money, excuse me, say that correctly, no out of the money covered call strikes, only in the money for active positions. So if you've got a position that you want to stay with and it's time to roll it to an in the money strike and no out of the money. Also, you'd want to stick with those lower beta positions. If you have a high beta position and you have profits, you might want to very much consider closing that down rather than rolling it out, given the current market conditions. It depends on your own circumstances, of course, but that's a consideration. Also, if you're wanting, and you're an aggressive trader and you're wanting to leg in, well, use conservative setups with well out of the money put selling, and might also want to consider a reduced position size of 1/3, and obviously keep that position size in the scale you're willing to own. So fat toe in the water is what we have with phase one, and that's what's being described here for the aggressive traders. Now, fat toe in the water, if you're a novice trader, probably, is for many novice traders means that you just kind of stand aside until conditions become more stable. Same thing for put selling. Very aggressive traders might initiate positions with this fat toe phase. If indeed it does prove to be a capitulation bottom and that's it, and we're going to race back to the top of the range, aggressive traders can be well suited to start putting on some positions and start scaling into some things. But again, for novice traders, probably still a very, very high risk condition to be able to do much with your capital. So kind of keep all that in mind. And let's see, what else do we have down here? In terms of sector specific, quite a bit of healing here. We've done a lot of technical damage. It's going to be a while before we see a sea of green up here. But certainly it is not a sea of red anymore. The last couple 2.5 trading sessions have certainly improved things. You notice though that the one that's showing up as all green is a very defensive sector. That should tell you something. Now, action was largely driven by energy on Friday, and you see energy had a huge up day. But even for the 1 week, the 1 month, that's still very, very negative here. So that is definitely a high beta kind of play. Even industrials was up about 0.76%. Utilities, of course, the most consistent performer of late, but still, well, perhaps telecommunication is the most consistent performer of late, but utilities also relatively consistent given its defensive posture. In terms of the relative rotation graph, this is just another reason to be very careful. You notice that there's not a lot up here in this upper right quadrant. semiconductors, real estate. We certainly see, and we have in our own core portfolio IYR holdings at this time, and then utilities. So the number 2 and number 3, which are both represented in the trading rooms holdings, are defensive positions. So this is not the kind of stuff, and even the one that's not defensive, the semiconductor, will look, it's tailing down, not moving up and to the right. So that should also be something of a warning to you. Okay, I think that's probably enough for today. And as always, if you find that what is useful in what we cover here is useful to your trading, there's a couple ways to get additional information. You can sign up to get emails directly from Falcon Global Traders, and there's 2 easy ways to do that. You can go to this website and just scroll down just a little bit, and you'll see this button, and you click on that button, you fill out your name and your email address, and that will put you on the email distribution list to get a very limited number of emails, including alerts when the hedge risk level changes, and then also periodic blog articles. Also, when you sign up, you'll get a link that'll take you to a copy of the ebook portfolio strategy that I wrote. So I think you might find that of interest. The other way you can get to the mailing list is you can, on your smartphone, text Falcon Global, all one word, no spaces, to this number here, 22828, and that will also put you on the mailing list. If you also subscribe to YouTube, that will also give you an email alert when new content has been published, and that can be very productive for you. And the other thing I would say about YouTube is just be aware that there are settings on there. You can click the gear to access the settings and change your playback to high definition, which is often very helpful to understanding what things are going on in these graphs and so forth. You can also go full screen, and last, you can speed up the video to 1.5 speed. So that's something to kind of keep in mind. I'm just going to scroll through the rest of this. If you have some special interest into some of these other offerings, you see the hyperlinks and the additional information. Disclaimers, as always, hit the pause button if you need more time to review, and you see the hyperlink down here for the full disclaimers. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading, everybody.